Did you know that 7 out of 10 Americans who have medical bills say that they have to lower their spending on food in order to avoid a medical bankruptcy? Navigating our highly complex world of healthcare and health benefits leaves many people feeling like a snowball in, well, you know where. I'm Josh Butler, healthcare consultant and advisor to more than 150 employers around the country, and this is A Snowball's Chance in Healthcare, a show about restoring hope in healthcare. Join us as we discuss ways you can lower your healthcare and benefits costs, how companies are winning the healthcare and benefits battle, and how hope is being restored to this community and communities across the country. Hello again, and welcome to another episode 11 of A Snowball's Chance in Healthcare. I'm Josh Butler, president of Butler Benefits and Consulting. We are a boutique healthcare consulting and brokerage firm located in Amarillo, Texas, God's country. And this show's all about, arming employers with information and tips and strategies and tactics. And we talk every week about how to give those people a snowball's chance in healthcare. So many times people feel frustrated. Healthcare is especially health benefits, is a very complex topic. But this week we're going to be tackling a subject that's no different. It's somewhat complicated, and we're going to be talking about self-funded health plans again. We talk a lot about self-funded health plans. It's pretty common to hear employers express a little bit of concern over being self-funded or what we call self-insured. I mean, if you just think about that term in and of itself, being self-insured kind of has a scary connotation to it, right? Versus being fully insured. And we're going to talk about a very important component in self-funding this week, and how that stacks up with fully insured plans. And just so everybody knows, what we're going to be talking about today is the subject of stop loss, okay? Oftentimes employers have said things to me like self-funding is too risky, or maybe we're not large enough to be self-funded. Self-funding is only for the largest employers. And sure, size of the organization does play a part. I mean, let's face it, if you've got 2 employees, it's going to be pretty difficult to be self-funded. But I can tell you, my smallest self-funded client has about 18 employees, and that's not a level-funded product. That is a traditionally self-funded employer. And size is a component to consider in self-funding, but I've even had large organizations, 300, 400, 500 employees, say similar things to me about self-funding's just too risky. Well, often when we continue that conversation, we continue that discussion, I typically find through asking some additional questions and further inquiring about their concerns or maybe even their fears and their skepticism, it really is more of an unfamiliarity with how self-funded plans work and how self-funding works in general that drives a lot of that skepticism or a lot of that fear or a lot of that maybe misinformation that they've even been fed. And so that's why we created A Snowball's Chance in Healthcare. I want employers to understand this industry better. I want them to understand these products that they're purchasing better. And why? It's because employers have a massive opportunity to impact the lives of their employees. And whether employers realize this or not, those employers, you employers out there, and I'm an employer too, and I wrestle with this sometimes. You're already, if you offer and sponsor an employee benefits plan, you're already making decisions for your employees that impact how, when, and where people get health care. Not to mention how much they're going to have to pay for it when they get it. So you're already in the insurance business. You're already in the healthcare business, whether you want to be or not, whether you realize it or not. And that's why, we talk about different vehicles and different strategies is to give you that snowball's chance in healthcare. Every organization that I know of is wanting to lower their healthcare benefits costs. They're wanting to lower their costs, but they don't want to compromise the integrity of their health plans and the quality of the benefits that employees get just to save a buck, right? And so That's why we focus a lot on the vehicle of self-funding or self-insurance. And that's really what self-funding is. It's a finance vehicle. It's just a mechanism to finance healthcare goods and services. It's not a solution in and of itself. It's simply a vehicle. Now, it's our opinion that it is a high-performing vehicle and that there's obviously some advantages to being self-funded, but it is not for every single organization. That's why we have a very thorough process that we go through with employers to evaluate claims data and plan designs and their demographics, and we spend a lot of time and money developing resources to see if companies are a good fit for a self-funded model. But self-funding is just a different way to pay for your health-related services and benefits. It gives employers control. It gives them more insight into their data and their analytics and things of that nature. But every day, it's not for every single employer out there, but every single day we're finding employers and we're helping them discover that self-funding is right for their organization. So today we're going to tackle a topic, and we're going to talk about one of the most important aspects of self-funding, and it's called stop-loss insurance. Many of you may have heard it called reinsurance or stop-loss insurance. And like I said, it sounds, when you hear the term self-insured or self-funded, it sounds like a company doesn't have any insurance whatsoever. And that there's no protection from that $1 million cancer claim or those pre-existing, or those, those premature twins. But there is insurance. And so for conversational purposes, I'm going to be a little bit more specific. The vast majority of self-funded companies are partially self-insured, not entirely self-insured. There's very, very few companies that have enough cash flow and they have enough liquidity where they can completely just pay 100% of all medical claims with no form of insurance to back them up in any capacity. But those companies are very, very few and far between. Most companies are purchasing stop-loss coverage. And stop-loss, for lack of a better description, it does exactly what it's called. It stops losses under certain circumstances, and that's what we're going to cover today. So I feel that the more people understand how stop-loss insurance works, they tend to get a whole lot more comfortable with self-funding in general. So that's what we're going to talk about today. Now, there are two different types of stop-loss coverage that most companies purchase, and that's what we're going to talk about today. The first one is called specific stop-loss. So there's two types, specific and aggregate. And the first one is specific stop-loss. And specific stop-loss deals with covering catastrophic losses for individual plan members. So think that catastrophic claim, that one person that maybe it's an extended COVID stay in the hospital, or maybe it was a major car accident, or maybe it's that premature twin situation. Those are individual catastrophic claims. And so the first type of insurance that self-funded employers purchase is called specific stop-loss, and that covers catastrophic losses for individual plan members. We're going to go a little bit deeper on that here in just a second. The second type of stop-loss coverage that self-funded plans purchase is called aggregate stop-loss or aggregate reinsurance. And what aggregate does is it caps losses on the entire organization, okay, on all covered members up to a specific amount. So everybody collectively, you combine all of their medical claims, and if it reaches a certain point and exceeds a certain point, or what we call pierces a certain point, then you have an insurance policy that reimburses your organization for losses beyond that point. So a company is buying two different types of protection through insurance. Protection for individual catastrophic claims and for volumes of claims that exceed a certain amount. Okay, so like I said, we're going to drill down into these a little bit more about these two different types of coverage. So specific stop loss, let's go back there. Like I said, it insures a single catastrophic claim that doesn't drain, so it doesn't drain the financial reserves of the self-funded plan. And aggregate ensures that a combination of numerous claims don't drain the reserves of the plan. Okay, so are you with me so far? Makes sense. Two different types of insurance that self-funded policies or self-funded plans are purchasing. So let's talk a little bit more about spec, okay, or specific stop loss. So I use the terms spec and ag. They're just, shortenings of the words that we use, and it's the industry lingo, so to speak, right? So a specific stop loss policy also has what we call a specific deductible that the company has to pay before losses are stopped, okay, before their losses are capped and stopped at a specific amount. Now, this is not the same thing as the employee's deductible amount in the plan design. So if you have a plan design with, say, a $3,500 deductible, and that's the employee's responsibility, and they've got to pay their deductible before the plan will cover them, this is not the same deductible, folks. This is a different deductible called a specific deductible that the employer has to pay, not that the employee has to pay. Okay, now, the self-funded plan, I'm going to use an example. So a company with 100 employees may have a specific deductible of, anywhere from $35,000 up to $50,000, okay? And so let's explain that. So all healthcare related services are paid for directly by the employer and the employees too, because remember, employees are contributing money like through payroll deduction in the form of premiums, and they're paying in, and a portion of their premiums are set aside to cover claims. And much of the company's contributions are also set aside to cover claims, right? And so this specific deductible amount can vary depending on the size of the organization. So let's use an example. Say you have a company with 100 employees. Now, a common specific deductible for a company that size is around $50,000. Now, I've seen some lower, and I've also seen some higher. But for this example's sake, we're going to use $50,000 as an example. So the company's going to directly pay for claims for an individual member up to $50,000. Anything beyond $50,000 is reimbursed. Okay, the company's losses are stopped at $50,000, and anything above that is reimbursed by an insurance policy, the specific stop loss policy, okay? And so I want to take a second to clear up a few things, because you might be thinking, man, that's a lot of money, $50,000. But guys, this is where data analytics and your data reporting and your utilization reporting plays a pivotal role here. Almost every single episode, we are talking about getting your data, get your claims data, get your utilization data, get your demographic data, because we talk about that on every single episode. So here's a question for you. How many of your employees in your company right now even get close to consuming $50,000 of healthcare services in a year? How many? Well, that's a question that you need to know. Okay, but I can tell you it's very, very few. Very few. So for those employers out there who have said things like, well, self-funding is just too risky. Well, you need to understand that self-funding is more of a calculated risk. It's not a blind risk. With your utilization data and your claims data, it's a calculated risk. It's a known risk in many instances, where we can show you, like with chronic disease, you can predict future claims, and this is the science of underwriting. This is what underwriters do. And even in fully insured plans, this is what the insurance companies are doing behind the scenes. They're utilizing utilization data, claims data, and all kinds of resources that their underwriters have access to. The only difference is they wrap it all up under one plan and give you one rate. Here's a rate. Well, here's the issue with that. What if somebody, like we covered this last week, what if your organization pays in $1 million in premiums, but you only have a $500,000 in claims? Well, that's a $500,000 profit leak, ladies and gentlemen. That's $500,000 that the insurance company gets to keep that your organization doesn't get to keep. And that's why employers look at self-funding, is because when you can manage risk, or you have good claims years, you get to reap the windfalls by paying those claims directly. And so that's why we spend countless hours and we invest lots of money analyzing people's utilizations, their trends, their claims data, their habits, their patterns, even their employees' behaviors. There's information out there that we leverage in order to underwrite these groups, and therefore it's a known risk, or it's a more calculated risk. So calculated risk or known risk can absolutely be better managed, and in many instances that risk can even be eliminated. This is why, you know, we use data analytics. This is why we use data, is to not just set your rates, but also to make people see that a $50,000 spec deductible is, yeah, it's possible in certain situations and you might have to pay it, but overall you're not going to have to pay that on every single employee in your company. So with specific stop loss, we're purchasing insurance, we're purchasing an insurance policy that will cover any losses on an individual, and in this example larger than $50,000 for an individual. Now, for some of our smaller partially self-funded employers, their spec levels, their spec deductible levels are commonly around $10,000 or $15,000. Okay, so while large organizations may have a spec deductible of $750,000 or $1 million, it's like I said, it's just depends on the size of the organization and, you know, their risk tolerance, and there's several factors that go into it. But companies that are a little bit more risk tolerant can also they can assume more risk. They can increase their own specific deductibles, and that can lower your specific stop loss premiums, okay, for your spec rates. And so that's spec insurance, okay, or specific stop loss. Now let's transition a little bit and let's talk about aggregate stop loss for a minute, okay? That's different. So aggregate coverage, what it does is it puts a cap on the amount that a self-funded employer has to pay across an entire plan year, okay? So having an aggregate stop loss policy helps the employer budget for its healthcare costs with some degree of accuracy, okay? So since the policy lets the employer put a dollar figure on its maximum potential liability for the plan year. That's what we call just the max liability. That's what a lot of employers are comparing to fully insured rates, is what is my maximum liability? Okay, now the maximum liability, like I said, is often compared to the fully insured rate because the maximum liability is your worst case scenario as a self-funded employer. A lot of times we describe it as if every wheel and every lug nut falls off the bus, then you've hit your maximum liability for a year. But aggregate coverage is an insurance policy that the employer takes out, and what it does is it takes every member's claims together. So all the employees, all the spouses and kiddos that are covered under the plan, it combines all of their claims under the specific deductible amount. So remember, a minute ago we used a specific deductible example of $50,000. Let's carry that example forward. So what the aggregate policy would do is combine all medical claims under $50,000, including pharmacy, and collectively, if it reaches a certain point, and that point's called your attachment point, okay, and if losses exceed that attachment point, then you have a policy that will reimburse the company any losses over that amount. So to those employers who've historically said self-funding's too risky, well, risk is tailored in a self-funded environment based on your size and your demographic, your risk tolerance, your tolerance for assuming, some risk, okay? And like I said, this is happening in a fully insured plan. It's just happening behind the scenes. They're doing all of this actuarial science behind the scenes. It's underwriting, right? And then they're just issuing you a rate, okay? So, like I said, the aggregate stop loss reimburses after what's called that attachment point. And in some ways, the attachment point is also like another deductible. It's a point at which the company's losses stop and then they're reimbursed by the policy. And the attachment point is a combination of all member claims, like I said, under that specific deductible amount. Okay? Now, the aggregate attachment point is commonly established by underwriters who are underwriting the risk of the plan. And what they do is they calculate what they call expected claims amounts, or expected monthly claims, And then what they do is they do the actuarial analysis on your demographic, on your company, on the network you use, on the whole 9 yards, and they come up with a figure what they expect your company to experience in claims for that given year. And then what they do, that's a dollar figure, okay? That's called expected claims. Then what they do is they multiply your expected claims, commonly, by 1.25 or 125%. So why 1.25? Why 125%? We call that 25% a corridor. Okay, so what the stop loss underwriter is saying here is we expect your claims to be X, but just in case we missed it a little bit, we're going to build in a 25% buffer, so to speak, or a safety gap, and we're going to add that to it. And that's going to establish your attachment point. So here's another example. The underwriter underwrites your group, and they anticipate that there's going to be $100,000 of claims, medical and pharmacy claims, in a year. Then what they'll typically do is multiply 100,000 by 1.25, so your attachment point would become $125,000. Okay? So in aggregate, if all of your losses as an organization under the specific deductible added up to $125,000, your company's losses are capped at $125,000, and then you would have a policy that would reimburse. So here we have two different policies. That's why we call it partially self-funded or partially self-insured. You're not totally self-funding your health benefits, because most self-funded plans purchase these two stop-loss policies, specific coverage and aggregate coverage. Now, we cover this in detail because it's important for employers to answer that question. Is self-funding too risky? Is it too big of a risk for my organization to take on? Well, the only way you're going to know that is if you go through what we call a self-funding. What we provide a lot of fully insured employers is what we call a self-funded feasibility analysis, where we take your information and we go to underwriting and we go share that information with our stop-loss markets, and we come back with an illustration. We're going to show you maximum liability. That's it. Worst case scenario, what your costs are going to be as an organization. And then we show you a more of an expected illustration of where we expect your claims to run over the next 12 months. And what you're going to find, a lot of companies, not every company, okay, let me be real clear, not every company, but many, many companies are finding and discovering that they're saving tremendous amounts of money, even at maximum liability, to convert from a fully insured model to a self-funded or partially self-funded model. Now, this is pretty simplistic overview of stop-loss insurance, but hopefully it helps make it clearer. And so in that example, hopefully these examples kind of helped you. But that's the two types of insurance. So get this thought out of your head, that if you think that self-funding is too risky, well, the only way you're going to know for sure it's not a gamble. It's a calculated risk. You got to get data. Show me the data. You got to get reporting. So you're not making a guess. We would never ask an employer group to just cross their fingers and trust me, right, and just hope that a self-funded plan is in their best interest. All of this has to be fleshed out and vetted out, and we do that with a lot of technology, a lot of underwriting technology, a lot of information and data. And so that's what we encourage a lot of our clients to do. That's what we encourage a lot of our prospects to look at, is because to me, it's the only way employers really have a chance. Again, if you come back and you're fully insured and your rate is set at $100,000 a year or $1 million a year, if your premiums are $1 million a year, no matter what your claims are for the entire year, even if you only had $5 in medical claims, you're going to give that insurance company $1 million in premium. And so is there some risk assumption involved with self-funding? Absolutely. But most employers that we talk to are happy to assume more risk, especially when it saves money. Yeah, they're having to pay directly for it, but that's why all these cost containment strategies that we spend a lot of time talking about on this program, things like direct primary care. We had Dr. Moore on the program. We had Mike Grant on this program. He's the CEO of the Surgery Center of Amarillo, an outpatient surgery center. And so when we can impact the unit cost of healthcare, it has a direct impact on self-funded employers. Those employers that are paying for those medical services, those surgeries, those prescription drugs, those doctor visits, they're paying for them directly. And so that's why we get employers into this vehicle. Then the game becomes, how well can we manage these claims? So remember, spec coverage, aggregate coverage, 2 key elements for self-funded employers. That's going to do it for another episode of A Snowball's Chance in Healthcare. My name is Josh Butler. I'm the president of Butler Benefits and Consulting, and each week we're arming employers with information and tips and strategies that they need to have a snowball's chance in healthcare.